Jim.
Right, thank you, Judy, and thank you everybody for staying back. I know it is late and it is appreciated. Basically, just to give you a quick idea, factoring has had a very bad reputation over the years. And one of the things that a lot of people have said, especially in a downturn, is that factoring is last resort finance. And the aim today is not to necessarily override that, but just to question that and sort of say, well, look, let's have a look at some of the ways in which you can use the tool to actually benefit your business. So it's really, hence the title is saying last resort finance or a powerful financial tool. So let's just kick off. We're going to be looking first of all in the first half at leveraging the power of factoring, because there are lots of areas relating to it that a lot of people just don't understand or haven't seen, and it's very much about trying to inform all of you about how that works. And the second half is looking at a couple of the tips on securing a facility, because we all know we're in the credit crunch and it's becoming increasingly hard to raise finance. So I just want to bring up a box, okay? Now, I just want the classic cliche, of course, is thinking outside the box. But what I want you to do is to actually think outside the four-wall box. Because in the Aussie economy, the majority of the banks fund businesses by using real estate as security. And the biggest problem is that it's flawed in certain ways for you as companies if you're looking towards expanding. Because the issue is that there is the banking way. And the banking way traditionally, with the greatest respect to bankers, because they are very good at what they do, if your business is not expanding and it's just staying static and you've just got a limited need for funds, then an overdraft secured by property is perhaps the easiest option and perhaps the cheapest. But if you're expanding, there are different issues that come to stake. Now, of course, property, we all know, is as safe as houses, and that's why the banks like it. The question is it? If we look at the statistics that have come through, and these were produced on the ABS website, that actually show that house prices are actually on the way down. Now, I can only speak for the local Sydney market at this particular stage in relation to a conversation I had about 2 weeks ago with a property valuer, where he was actually highlighting that properties over $1 million have fallen by 10%, and properties over $3 million have fallen by 20%. And clearly at the bottom end with the homeowners grant, that's propping up the house prices. But the reality is that house prices are actually falling. And again, from the ABS statistics, you can see how the house prices are actually performing. So the big question is, how will the banks react? And the issue is that falling asset values actually means the level of security available for the banks is actually going to fall. And if history is anything to go by, when there's recession around, history always shows that banks want to reduce their exposure. And we're seeing that already. We're seeing that already, that overdrafts and other facilities are under pressure because house prices are beginning to take a dip. I actually lent in the last recession, admittedly in the UK, and saw some disgraceful behaviour by some bankers, not necessarily having a go at the banks, but by some bankers, when they found that the security values were falling. They did some rather nasty tricks. So where does that leave an expanding business? Well, it's a question really of trying to explore some ideas outside of the four-wall box. And basically, the first thing I want to bring up is the majority of factoring companies will not take property security to support the facilities. There are exceptions to the rule, of course, and if the facilities are non-standard, and, for example, if you're looking at areas relating to the construction sector, property may be required. But in the majority of cases, property is not. They primarily focus their minds on the business assets, most notably the invoices of the business to fund it. Factoring can therefore help you de-risk your own personal position. It can free up your property to actually take that bit of personal risk out of the equation. Perhaps that's particularly important given the recessionary times.